In Germany, the Volkswagen ID.3 costs about $35,000 after rebates. In China, the nearly identical model sells for less than half that price. This price difference stems from Volkswagen's struggle in a fierce Chinese price war, where the company is cutting prices to maintain its market position. Foreign automakers are losing ground, their sales are slowing, market share is shrinking, and reviews have been harsh. Chinese car companies are now rising and preparing to export their electric models globally. For them, any market outside China is currently easier than the domestic market. Why are the world's largest automakers suddenly failing in their most important market? To what extent is Beijing's industrial policy responsible, and to what extent have the automakers themselves made mistakes? For instance, their batteries are not superior to those of competitors, and their software is often worse. This episode of Business Beyond answers these questions and examines how Chinese electric vehicles could reshape the global automotive industry. To understand the current situation in China, it helps to look at how it began. Volkswagen's story is particularly instructive. In 1978, China had just emerged from the Cultural Revolution and was still poor. Needing vehicles, the country turned to Germany. A Chinese delegation, led by the Minister for Industry, arrived unannounced at Volkswagen's headquarters in Wolfsburg. Felix Li, a former China correspondent for a German newspaper, recounts this event. His father was a department head at Volkswagen in 1978. Someone from the main entrance asked his father if he still spoke Chinese because a visitor claimed to be the Minister for Mechanics and Industry. Initially skeptical, his father realized the delegation was more interested in trucks and buses than private cars, which Chinese households could not yet afford. The parties agreed on an alternative approach, selling Volkswagen cars as taxis and for government use. Given China's size, even this limited market was worthwhile for Volkswagen. In 1984, German Chancellor Helmut Kohl traveled to China, marking the official start of Volkswagen's venture there. What followed is well known. China transformed from a poor nation into an economic powerhouse. As personal incomes rose, so did the market for private cars. Although other companies like Toyota, GM, and Ford entered China later, none matched Volkswagen's success. Into the early 2000s, Volkswagen held 50% of the Chinese passenger car market, a significant advantage gained by being first. However, this success brought risks, particularly a growing dependence on the Chinese market. For Volkswagen, more and more sales were tied to one country and to internal combustion engine models. China wanted to develop its own automotive industry but had little success after years of struggling with gasoline engine production. Then, a new technology emerged. In 2001, China began funding research and development for battery electric vehicles, fuel cells, and hybrids. A shift to electric vehicles created a more level playing field, giving Chinese automakers a better chance to compete directly with foreign companies. This move was initially a gamble. Around 2009 to 2010, it was a pet project of the Ministry of Science and Technology with limited attention elsewhere. By 2015, the situation had changed. A full supply chain for electric vehicles had developed, leveraging China's industrial expertise, battery production, and mineral refining. Established companies like BYD, formerly a phone battery manufacturer, found new purpose in electric vehicles. Startups like Leapmotor and NIO quickly gained prominence. Beijing supported these companies not only with subsidies and government purchases but also with implicit support like access to credit and below-market equity. For example, in 2020, a struggling Chinese company received a local government funding injection that saved it, and it is now performing well. Beijing could stabilize young companies with cheap capital or by purchasing shares. The main problem with China's new EV market was that the quality was insufficient to compete globally with brands like Tesla. This changed when Beijing allowed Tesla to build a factory in Shanghai. Tesla's entry shifted the market. Production scaled up, and when Giga Shanghai became fully operational in 2020, the EV market took off. Tesla's appeal as an iconic American brand, coupled with its direct sales approach, shook up the market. Tesla not only raised the bar for China's EV market but also improved the standards for Chinese suppliers, who then could offer the same quality to domestic carmakers. Chinese cars began to meet all major requirements, they were built faster, less expensive, and their quality was comparable or better. In 2021, passenger EV sales in China surged by 170% from the previous year to about 3 million vehicles, representing half of all global EV sales that year. BYD was the top seller, with Tesla in third place. Challenges for foreign automakers. Major automakers faced several problems with electric vehicles, including battery costs and software. Companies with strong engineering backgrounds were not necessarily proficient in programming. This became evident when Volkswagen launched the ID.3 in 2021, its first EV hatchback on a dedicated platform. The operating system was buggy, slow, and required dealership updates, while Chinese automakers were already performing updates remotely. Chinese reviewers were critical of the ID.3. One reviewer noted that compared to BYD or SAIC, the ID.3 system required harsh criticism. Others were unsurprised, having had low expectations for Volkswagen software. Other foreign automakers also encountered issues. Both Mercedes and Toyota issued recalls in China due to software problems. Even Tesla faced a major recall for its software. Beyond glitches, many new foreign EVs were more limited than their Chinese rivals, lacking features like selfie cameras or karaoke. For Chinese tech companies, a car is software on wheels, and their approach is fundamentally different. Digital connectivity has become crucial for Chinese consumers, who often drive short distances in congested cities like Beijing or Shanghai. For Volkswagen executives, karaoke became a symbol of early mistakes, representing both software problems and a fundamental misreading of the Chinese market. While admitting the problem is a first step, software issues continue to plague major automakers in China, including Volkswagen, Toyota, and Honda. These are just part of a broader set of challenges, from reliability to features and even growing Chinese consumer nationalism. Volkswagen lacks distinguishing features that set it apart from Chinese competitors. Its batteries are not better, and its software is often worse. Why would consumers buy a Volkswagen when a BYD is cheaper? One solution has been to lower prices. In China, prices are falling rapidly, but this is more a necessity than a strategy. The market is overcrowded, forcing automakers to take desperate measures to maintain market share. Volkswagen's sales increased in August due to price cuts, but its overall market share continues to decline as customers buy fewer non-electric models. After years of maintaining around 15% market share in China, Volkswagen dropped to nearly 11% last year. Toyota and Honda fared worse, losing close to 6%. In the first half of this year, BYD overtook Volkswagen as the top brand in China. The large automakers have learned a painful lesson: do not rest on past accomplishments, and do not underestimate Beijing's industrial policies. Western executives were consistently surprised that China's policy moved forward and that Chinese automakers took it seriously, investing in R&D and succeeding. Volkswagen is now acting quickly to address the damage by investing more in Chinese technology. It has established 2 new joint ventures in recent months, one with Chinese software maker Thundersoft and another with Chinese automaker XPeng, aiming to develop 2 new models by 2026. These steps set Volkswagen apart from other struggling automakers, such as Toyota, which has a tie-up with BYD but nothing as intensive. Volkswagen is eager to avoid losing its position in the Chinese market. The problem is that automakers have lost valuable time. Now, another challenge is emerging: the crowded domestic market is pushing Chinese automakers to seek opportunities overseas, which could create more trouble for the major automakers. At this year's IAA Auto Show in Munich, BYD was a highly anticipated exhibitor, unveiling 5 new models for the European market. Consumers worldwide, not just in China, want more digitally connected cars. The Chinese consumer may be a bellwether for global consumer preferences. These changes are happening now, and their outcome may be the topic of a future Business Beyond episode. Thank you for watching. We will see you soon.